Alright, who's still calling me a reverse indicator now? I've been warning you about the downside risk in gold for 3 straight videos. And right on cue this afternoon, gold started dumping south, slicing straight through the critical 4,650 support level like butter. And meanwhile, Brent crude just reaped past the $110 macro level. Most of the retail traders haven't even processed what's happening. The real macro catalyst today was actually the Bank of Japan turning ultra hawkish. The BOJ policy decision just dropped. They kept rates flat, but we saw a massive rear split in the board. 3 members actually voted for an immediate hike to 1%, up from just 1 previously. And plus, the BOJ aggressively revised their CPI forecasts up to 2.8%. This massively front-loads the expectations for a June rate hike. And for gold, this is an absolute macro nightmare. For years, global institutions have been running the yen carry trade, borrowing free yen to lever up on gold and treasuries. Now that Japan is hiking, borrowing costs are spiking, forcing funds to liquidate gold to cover their yen shorts. History is critical clear on this. When the BOJ hikes, gold reverses hard. Gold isn't trading on safe haven flows right now. It's trading purely on rates. Okay, now let's look at US equities. The Nasdaq printed fresh all-time highs again last night. And semis, telecom, and memory chips are still the heavy lifting engines for the bulls. Intel is seeing massive inflows after crushing earnings. Their CPUs are so hot right now. They are literally selling out of defective chips. And Nvidia just smashed past the $5 trillion market cap. But beneath this euphoria, there's a massive red flag you cannot ignore.
The VIX, the market's fear gauge, closed at 18.24 and up 1.22% on the day.
While the S&P and Nasdaq are reaping to new highs, the VIX isn't dropping. And instead, it's printing higher lows. The market is pumping, but doesn't it feel a little terrifying? And my gut tells me, starting Wednesday, the market is going to get violently choppy. Wednesday kicks off earnings for Microsoft, Google, Amazon, and Meta. Wall Street is going to be hyper-focused on the CapEx numbers. And Thursday is an absolute macro news. Q1 GDP, core PCE, and Fed FOMC meeting, and Apple earnings. So don't get blinded by the green tape. Goldman Sachs trading desk just issue a massive warning. If the S&P 500 breaks below 6,725 on any sudden bearish catalyst, CTA algos would instantly and ruthlessly flee from net long to net short, and triggering a mechanical $29.9 billion liquidation stampede in the massive equity supply coming from the end of Mount pension rebalancing, and the liquidity propping up this market is drying up fast. We're literally walking on this cliff edge. Call me a reverse indicator again if you want. Just treat it as me rambling. The only reason institutional money is still partying right now is built on the blind faith that AI mega caps can defy the macro cycle and print infinite profits. But do not forget, if the Fed comes out and officially take rate cuts off the table, the bond market will puke first, followed by a brutal valuation slaughter in tech. And plus, we have the upcoming Fed leadership transition. Historically, there's a curse. Every time the Fed chair changes, the market crashes. Will this time be any different? And finally, let's talk about crude. A lot of people are still misreading the tape here. Notice how no matter how many times Trump tries to drop on oil lower, it keeps violently reclaiming the $100 level. This is absolutely not a top-paying formation. It's printing higher lows. Goldman's latest macro DAX note spells it out. If this geopolitical gridlock continues, oil is going straight to $120. The actual transit rate through this trade is still practically zero. We are staring at a massive supply deficit of 14 million barrels a day. Yet the market is pricing this in with shocking complacency. So in my view, shorting oil right now is incredibly toxic. As always, this is just my personal trade analysis, not financial advice. And shout out to EBC Financial Group for sponsoring this content.